Welcome back, everybody. The big news this week was that Fed Chair Jerome Powell has finally given official confirmation that rate cuts are likely on the way. But what does that actually mean for our stocks? Well, we're going to get into that. Plus, one of the big winners in the market this year is a stock that I actually sold way back in January, and since it's gone up a whopping 40%. So we're going to break that down as well. Let's go ahead and get started. Now, obviously, everyone is talking about Jerome Powell and the Fed finally coming out and saying that rate cuts are coming soon with, quote, "the time has come for policy to adjust." And this happened at their Jackson Hole summit after learning that the labor market was weaker than first reported, and with inflation coming down to about 2.9%, close to the Fed's long-term target of 2%. And if you're wondering why they would change the policy before they hit 2%, well, it's because they're gradually trying to move the economy in the right direction. It's kind of like when you're driving and you're coming up to a stop sign and you're slowly braking and gradually slowing down before you get to the stop sign, unless you drive in San Antonio where apparently stop signs are optional. But I view this as the Fed trying to learn from the mistake they made when raising rates in 2021 and 2022 because they waited too long to start and then had to raise dramatically in a short period of time. So now that we know that rate cuts are on the way, what does that actually mean for our stocks? Now, I think the prevailing wisdom is that, well, a rate cut should be good for stocks, but I have a slightly different view because at the end of the day, it's still going to matter how these companies are actually earning as opposed to just rates being lower. But still, we know that rates do have some impact, and we've talked about this before because way back almost a year ago, I talked about this in relation to why SCHD was performing poorly in 2023. And here's what I said. Interest rates in the U.S. have risen, and in general, this impacts certain investments and certain type of stocks more than others. And here's why. So first, profits are impacted by rising rates. A company's profits can be impacted by rising interest rates in a couple different ways. One, if they have a lot of debt, the cost to service that debt can rise quickly depending on their timelines and terms. And two, the ability to grow as a company slows down as cost of capital goes up. So companies look to cut costs and get lean since the growth prospects aren't as great or easily accessible. And then three, businesses with international income will see lower revenues. When the dollar is stronger compared to other currencies, it means international revenues tend to be lower due to the exchange rates. And that's why you heard the phrase currency neutral basis all over earnings calls over the past few months. These are companies trying to show that their results would have been stronger except for that currency conversion. And in some cases, companies can be impacted by all three of those things. But ultimately, if investors think profits are going to be impacted, then it can bring stock prices down as they look for other places to put their money. Which brings me to the second reason stocks get impacted by rising rates. There's more places to put your money, especially for investors who are trying to generate an attractive yield. In 2021, the 10-year Treasury yield was 0.93%. Savings accounts were paying just about nothing. So the best option a lot of times is a quality dividend-paying stock where you can get 3 to 4%. So just like the market, dividend-paying stocks and ETFs did extremely well. But fast forward to 2023, and we're in a different world. The 10-year treasuries are over 4%. Savings accounts and money markets are 4 to 5% easy. So income investors can get the same yield they were getting before, maybe a little more, with little to no risk at all. Or if they want to take some risk, they're going for high-yield derivative income funds like JEPI or the Yield Max funds to try to take advantage of a down and choppy market. So naturally, you're going to see money flowing out of traditional dividend investments and more into treasuries and high-yielding assets. And the type of dividend stocks that are going to get hit the most by this are the ones that are usually the most attractive to income investors. And that basically includes REITs, or real estate investment trusts, because they usually pay a high dividend, so they're a favorite of income investors. Plus, they usually carry a lot of debt, so they're likely to see profits and expansion opportunities go down, which is a double whammy. And then also utilities and telecom services. Now, these companies usually pay a good, stable dividend, and they tend to use and carry a lot of debt as well. So again, they're favorites of income investors and likely to see impacts to their profitability. And then lastly, high-yielding dividend stocks and dividend aristocrats that are stable but grow slowly. Because again, the stability and high dividend yield are attractive to income-focused investors. So naturally, as we look for rates to come down a bit, you would expect for those type of companies to get a lift. So REITs, utilities, high-yielding dividend stocks are all likely to see a little bit more activity. Plus, just more capital in general back into the market as investors start to put their money back into stocks that they might have had in treasuries. But I still think the question is around what's the actual end result of this going to be, and that's where I have a slightly different view than maybe other people do. Because I do think there's a chance that the labor market pain may be prolonged and that the economy is likely a little worse than we may expect. I also think that interest rates are more likely to stay at close to current levels than to retest anything like it was before, like below 1%. So for me personally, I think higher for longer is going to be a thing even if we start cutting rates soon, because I just can't see us going back to the rate levels that we had before where it was like 0 to 1%. So while they may cut 1 to 2%, that is definitely significant. It's just not like the previous period where basically any money that you had was going into stocks. And this is something that I've been thinking about for a while. And you can see it in the changes that I've made in my portfolio over the last year. And if we take a look at some of the stocks I've sold over the last year, it's stocks like Lowe's, Waste Management, Starbucks, Walmart, Caterpillar, and Valero. And if we take a look at their balance sheets, we can see some commonalities. All of these companies tend to have a relatively high amount of debt. If we look at debt to free cash flow, you can see all of them are above a certain level, with the exception of Valero. And actually, Valero is the one exception to this because I actually thought that their debt levels were pretty manageable, but they had problems in the other area. And that other area was growth prospects. Because if we look at the growth prospects for all these companies, they're all relatively low. And in some cases, they're actually negative. But none of them are actually above 6%, with Walmart being the only one above 5%. And even if we look at projected revenue growth, we can see that the highest one is Starbucks at a little under 7%. So just overall, the revenue growth for these companies that are also high debt holders is not very good. Now, obviously, revenue growth isn't the be-all end-all because it ultimately just matters how much of that revenue you're converting to earnings and free cash flow. But again, remember that the debt to free cash flow ratios for these companies were really high, which means that if rates are higher for longer, then that free cash flow, those earnings, they're going to be squeezed a little bit because they're carrying a lot of debt on their balance sheets. And now if we compare that to some of the companies that I've added this year, like Amazon, Nvidia, Meta, Lululemon, Google, and MSCI, if we come down to their balance sheet metrics, we can see that their debt to free cash flow looks much healthier, with all of them basically being lower than the other group, with the exception of MSCI. And MSCI is one of those ones where they did take on a lot of debt for acquisitions, and it's something that I'm monitoring specifically for them. But if we go up to the growth metrics for this group, you can see that it's all significantly better, with all the growth rates above 10%, or in this case above 12%. And then even if you look at their projected revenue growth, they're all above 10%. So part of what I've been doing in my portfolio is trying to make it less sensitive to interest rates. So regardless of what happens with rates going up or down, I'm basically replacing high debt, low growth companies with low to minimal debt and high growth companies so that if investors have to be choosy, I'm thinking they're going to choose companies that look like that. Now, obviously, time will tell if that plays out the way that I expect, but I would at least expect a little bit of a bump for some of these stocks like REITs, utilities, and my beloved McDonald's. And honestly, I think we've already started to see this play out because over the last month, McDonald's is up 12.5%. And if we take a look at the different market sectors, what we see is the two best performing sectors over the past month are utilities and real estate. So it seems like in general that lift has already started as people anticipate the rate cuts being on the way. So it's going to be a question of how much they cut and when, and probably more importantly, how far they tend to go down. Like, is it going to be below 4%, below 3%? Because I would imagine that if it stays a little bit higher than people expect, then this lift may just be temporary, and we'll kind of go back to okay, what are the strongest companies in the market that carry a low amount of debt but still have good growth prospects? But obviously, we'll just have to see. So speaking of companies that I cut, let's talk about Walmart. Now, my whole thesis on Walmart back when I bought it in June of 2023 was that even though revenue growth was slow or at least steady, they had made a lot of investments to where operating income was going to accelerate, which would accelerate free cash flow, which would accelerate dividend growth. And ultimately, because they were a great recession stock, that would benefit them even more. And what we saw from them in the first 3 quarters is that it kind of did that, but then slowed down. They initially had revenue growth of 7.6% and operating income growing faster at 17.3%. And then the next quarter, revenue growth was slowed a little bit, but still operating income grew faster than revenue at 6.7%. And then we got to the end of 2023, revenue growth decelerated a little bit, and all of a sudden they're not talking about operating income. And if we come down here, we can see that operating income was actually up only 3%. So at this point, that story of revenue growth is steady, but operating income would accelerate was kind of struggling a little bit, or at least it has slowed down for this quarter. And if we take a look at Walmart's performance in my portfolio, when I bought it on June 20th and up to the point that I sold on January 4th, the performance was basically 1.2% compared to the S&P 500's close to 7%. So at that point, I'd owned Walmart for about 6 months, and the price return that I got, excluding dividends, was 1.2%, which is not great. But again, I had a thesis, and it kind of played out, but seemed to be slowing. But since I sold Walmart, what we've basically seen is that since January 4th, Walmart has gained 42.78% compared to the S&P 500's 20%, which means on a relative basis, Walmart has outpaced the S&P 500 by 22 percentage points in 2024, which is just amazing performance. And so the first thing you think about is, wow, what a big mistake, right? I could have had that performance in my portfolio. And if we take a look at where it would stack up, I mean, Walmart would have been right here under NVIDIA in terms of total percent change, which was right around where I had Caterpillar and Valero and other big winners. So it would have been one of the biggest winners in my portfolio had I held on. So why did this actually happen? Well, let's take a look at what they reported since then. So in that next quarter after, revenue growth again was steady, but look at operating income growth, 30.4%, and then adjusted operating income still up 13.2%. So of course, we're seeing an acceleration back from where it was before. And then if we look at the last 2 quarters, revenue growth again 6%, so it's accelerating. Operating income again 9.6, so it's higher than revenues. Adjusted 13.7, so again very strong. And then looking at this last quarter, revenue growth was okay, but again operating income growing faster than revenues at 8.5%. Plus, Walmart had announced earlier in the year a 3-for-1 stock split to help their associates be able to invest back into the company a little bit easier, which obviously also helped. Not to mention the fact that the economy actually did start worsening, which is good for Walmart since their whole brand is based on giving value back to customers. So this is a really great example where my idea and my analysis was really good, but I just didn't have the patience to let it play out as long as it needed to. Now, obviously, this is going to happen sometimes, right? Like not every decision we're going to make is going to work out, or at least work out in the way that we expect it to. But my goal was still to replace these high debt, low growth companies with more low debt, high growth companies, and I definitely did that. So we'll just have to see how it turns out over a longer period of time. But I do think what's important here is that we need to understand why we make the decisions we make. Otherwise, when you see Walmart go up 40% after I sold, I could totally be freaking out about, oh man, I made a mistake. And maybe I did, but at the end of the day, it was very logical as to why I did it. And my plan for that is still playing out over time. But knowing the reason why I did it gives me the confidence to not overreact to the fact that it went up a lot after I sold. I mean, that's just going to happen sometimes. But at least if you understand why you did it, then you can base your decision and your reaction on the fundamentals and the logic that you had involved, as opposed to just market price. So while it would have been nice to get that 40% gain, at least I know that my initial analysis was pretty solid. I just didn't allow it to play out in the time that it needed. But at the end of the day, I know why I did what I did, and I'm moving forward. So I'm going to go ahead and leave you guys with that. Now, I don't know how this next week's going to go, but up until this point, I'm pretty excited to share with you my August portfolio update. But if you want to see my latest one from last month, you can do that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.